morning friends. I welcome you all today for a program on FEMA Act. Today we will be discussing about the regulations on foreign exchange. So it's a pleasure that I have been given this task to do this needful activity for you all. So let's start with the basic applications of FEMA, and first of all we'll discuss the basic overview of FEMA and how it is different from FERA, because earlier in India we have a 1973 Act of FERA which talks about the governance of the foreign exchange, but it really talks about the several penal provisions and the actions which is basically focusing on the search, seizure and the control of the foreign exchange transactions. So what I mean to say, when we have the earlier provisions of FERA Act, we were more talking about the regulations aspects which generally focuses on the search and seizure procedure on foreign exchange transaction, which means it was not a management act, it was more of a regulation act, and it was not focusing on that how to facilitate the activities of foreign exchange, rather than it was focusing on the search and seizure procedures of the foreign exchange transactions. So then Government of India recognized the fact that we must shift from the FERA to FEMA, because in FERA we were focusing on the blanket powers and the imprisonment actions and the mens rea consumptions of the FERA. So that's why we need a concept of FEMA. Now FEMA focuses on the external trade and focusing on to facilitate the trading activities, so that when any community on the business side want to do any foreign exchange transactions, so they can get certain appraisals from the Government of India, as well as they can get to know about the focusing on how the government will facilitate those activities on the foreign exchange transactions. So that's why there was a paradigm shift from the previous act of FERA to a FEMA Act. And FEMA actually helps the corporate world to do foreign exchange so that they can generate foreign exchange currencies to the Indian economy. So from this FERA Act we shifted to the act which is known as FEMA, because it was more of the foreign exchange management. It talks about how to manage the foreign exchange rather than only threatening the corporates to trade on foreign exchange. Now let's understand the broad framework of the FEMA and how it was in existence, and what is the regulation of the central government and RBI, and how they facilitate the trade in the international community. So the amendment came in 2000, because the act was developed in 1999, and the basic focus of FEMA was to develop the foreign exchange transactions so that the trade can be facilitated and corporates can easily do their transactions on export side or on the import side. Because friends, it's really important for the Government of India as well as for the Indian economy that we must generate foreign exchange, because in 1992 we were having a very high shortage on the foreign exchange transactions and the currency, particularly in the dollar terms. So that's why the Government of India recognized the need of foreign exchange, and that's how we get into this FEMA Act, which actually facilitate the foreign exchange transactions. So here we have that the regulations are generally notified by the RBI, which talks about whether your transactions is of a current account or of capital account, and based on those current account and capital account there are certain nomenclatures as well as certain requirements that to what extent you need to bring the foreign exchange, what is the time frame, to what extent you can go for current account convertibility or capital account convertibility. So we'll be focusing on that perspective, but first of all the basic aim of FEMA was to facilitate the transactions and to facilitate the corporates on foreign exchange. So now let's come to the different sections and the different provisions which we'll be discussing today. So we'll be focusing on the applications of FEMA. We discuss about the definitions which have been given by FEMA as far as the person of Indian origins, NRIs, and whether the provisions will be applicable to an Indian or not. And then we will focus on the authorized persons who are basically authorized by the government to trade in foreign exchange. For example, we have hotels, we have travelers companies, like Thomas Cook, who have been authorized by the Government of India as an authorized dealers. Besides this, we have banks as well who are very much into this process. Then we will focus on certain contraventions and penalties which have been there in this act, and at the end of the program we will talk about some of the miscellaneous provisions of this act. So first of all, let's talk about the scope of FEMA and the definitions which have been covered under this FEMA Act and what this Act talks about. So as we can see, the FEMA is basically applicable across the country, and it is basically for those who are basically doing the transactions and trades in India or outside India. So there we're talking about the two type of activities. We're talking about the inbound activities and we're talking about the outbound activities. So whenever we trade within India or whenever we trade outside India broadly, we need to be governed by the FEMA Act, because any transactions which is being done outside India, whether as an export or import, it is broadly governed by the same Act. Now first of all, we talk about the definition of the person. That in FEMA Act, as you are aware of the concept of Income Tax Act, that FEMA again talks about the definition of a person, and here it talks in the similar fashion as Income Tax Act states, but there is a difference between the Income Tax Act and the FEMA Act on the definitions which we will be taking. The first of all, the definition of the person is, it talks about individuals, HUF, company, firm, associations, body of individuals, any artificial jurisdictional person or any agency. So the person encompasses almost all those who are basically governed by this Act, so that whenever you trade any international transaction, you will be governed by this Act. And that could be in the form of, whether you are doing in the form of a current account or you are doing in the form of a capital account transactions. Because broadly, any transaction in foreign exchange is either a current account transaction or it is a capital account transaction, which we will be discussing in detail. Because when we talk about current account, it is broadly an export or import, which is basically a trading activity or the transfer of goods and services. And whenever we talk about the capital account, it talks about the investment in the business, or when we talk about the deals which is being done in the form of joint ventures, or where the money is being invested in the company and a company is being created either in India or outside India. So that is governed by the capital account transactions, where the currency flows from one country to another country as a part of long-term investments. So there is a difference between the investment and the trade. So when we talk about the trading activities, we generally talk about the current account transactions, and whenever we talk about the investment activities, we generally speak about the capital account transactions. So first of all, this distinguishment is very much there when we talk about the FEMA Act. Now let's come to the basic application of the characteristic for a person resident in India. Now here you can see the Act again explains, if a person is residing in India more than 182 days, he will be said to be a person resident in India, but it does not include if a person has gone out of India because of an employment or because of any business or vocation, or for any period for which the number of days are not certain. And similarly, it will not cover the person who comes or stays in India for taking up an employment or carrying on a business or vocation in India. So what I mean to explain you on this is that here it is quite different from what we have discussed, or you must be aware of the fact given in Income Tax Act, because here we talks about that this will be covering only if you are having a stay of more than 182 days in the preceding financial year, and it doesn't talk about those 60 days or 365 days or last 7 years, because this definition is slightly different from as being covered in Income Tax Act. So what I mean to say that you might be governed as a resident as per Income Tax Act, but not be as a resident as per FEMA Act. So my dear friends, this is one of the very important difference which you need to understand, that Income Tax Act has a different governance as compared to the FEMA Act. And then again they say that person resident outside India, PRY, and that's, you are aware of the act definition is very simple, that a person resident outside India means a person who is not a resident in India. So they have given a definition of PRI, and if you are not covered under PRI, then automatically you become PROI, which is person resident outside India. Now as we can see in the second point, that an NRI is a person resident outside India who is citizen of India or a person of Indian origin, and it is possible that you may be NRI under FEMA, yet you may be resident under income tax law. So this particular aspect, that you might be an NRI under FEMA Act and you might be a resident under Income Tax Act, because these are two separate acts, these are two separate laws. FEMA is a separate act and income tax is a separate, so therefore you cannot gel up with the FEMA with income tax. So that's why it is quite possible that a person could be an NRI, under FEMA and might be a resident as per the act. So that's how we define the definition of the person, and the difficult aspect of this FEMA Act could be that they have different definitions under different regulations. When you talk about a deposit regulation, they define a separate definition of person of Indian origin, which we will be discussing in detail. When you talk about the acquisition of immovable property in India, then there is another definition of person of Indian origin. And when you talk about their proprietary investments in India, under section regulation 2 of FEMA 24, they have another definition. So what I mean to say is that person of Indian origin is being categorically defined under different regulations of the same FEMA Act. So here we need to be very much particular as far as the person of Indian origin as for the different regulations. But the broader outlook of POI means a citizen of any country other than Bangladesh or Pakistan, if he hold or held the Indian passport, or he or either of his parents or his grandparents was a citizen of India by the virtue of Constitution of India or by the Citizenship Act, or a person is a spouse of Indian citizen or a person referred in subclause 1 or 2 above. So what I mean to say is that PIO is being categorically defined, this as per the FEMA Act, and as per the Foreign Exchange Management Regulation Act, we have one set of applications of FEMA which might be different from the different acts as well. So you cannot say that I am not a resident of India as per this act, so why you are charging taxes to me? So that could be slightly different from the other one. Now, before I come to the capital account and current account, let's understand what do you mean by the basic application of capital transactions and what are the current account transactions. So the concept is very simple, that whenever we talk about the current account, as you can see, that it talks about the trading, it talks about the activities which are basically on the business front, or which is basically facilitating you the foreign trade. So whenever you are doing any foreign trade, it is a part of a current account transactions. It talks about the remittances, it talks about the transfer of money, or even it talks about the travel. When you do a foreign travel, it is again a part of your current account applications. But when we talk about the capital account, here we talk about more of the transactions which are in the form of assets or liability, or when you are investing in a business more as an FDI applications, or when you are basically doing a joint venture deal or any investment in a company, might be doing as a shareholding in that company. So here the definition and the inclusion will be different from what we talk about a current account, because in the convertibility aspect, again we will discuss in detail that in current account in India we have 100% convertibility is there, but in the capital account the 100% convertibility is not there in all the areas. In some phases we have 100%, in some areas we don't have, as we have seen in the recent budget that they are talking about that you have a 49% of investments in the insurance sector. So here we say that this investment in India is basically an FDI applications or a capital account transaction where you can go for an investment of 49%, but this 49% is a cap. So we don't say that we have a 100% convertibility of a foreign exchange as far as the capital account transactions are concerned, because the basic differentiation between the current account and capital account comes on that to what extent you can transfer your foreign exchange to the domestic currency, because in India we have INR, then we have transaction in dollar terms. So to what extent we can ask for the dollars and to what extent we will be getting dollars. So that talks about the current account and capital account, because whenever you are dealing in any current account you can ask for any amount of dollars as far as your repayments are concerned or as far as your repatriations are concerned, because there is no restrictions on the transfer of money on the current account on the dollar side or on any foreign exchange currency side. But when we talk about the capital account, yes, there is a limiting factor, and there are certain criteria based on which you have to get your investments done in India, or outside India, and that's how we have to explain the inbound and outbound applications, on the capital account transactions. So capital account is slightly, we have certain restrictions. In current account we have free trade zones. So we can discuss so far is like what is FERA, then how come we shifted from FERA to FEMA. Then we discuss about what is the person, what is the definition of a person, who is PROI and who is NRI as per the FEMA Act. And then finally we are basically distinguishing between the current account transactions and the capital account transactions. So now in our second part we will be discussing about the different sections and the applications of FEMA Act.